Hello, everybody. Happy Friday, and welcome to another edition of the Real Life Real Estate Investing Show, the show where we guide you to creating generational wealth using real estate. My name is Hector Hernandez, and I'm a real estate fund manager. I'm also a real estate coach here on reallifetrading.com. As always, joining me today and every other day that we are here for the most part, my buddy, my pal, my brother from another mother, Mr. Luis Alejandro Lopez is here today. What you got for us today, Lou?
I'm having a great time today. Happy Friday, everybody. It's usually the last Friday of the month. And my name is Luis Alejandro Lopez. I'm here with you guys to the Real Life Real Estate Show, where we're going to be talking about insurance issues, insurance woes. Before we think about anything else, let me see, make sure that our guests can be turned on the camera. Greg, can you do it? If not, we're gonna play with that while I do our intro. First of all, as usual, we are two guys on the internet. We're gonna be talking about insurance. Insurance saved their butt. If you heard about the flip that got flipped that we had last year, we had a property that was ready for sale in Port Charlotte, and Hurricane Ian went and basically destroyed the whole house. So insurance saved their butt. Now, insurance has been saving everybody's butt for a long time, and insurance now is going up. So we have a guest here who's going to talk to us about it. Now, as usual, we're two guys on the internet that we've been doing for a long time. We think we know what we're doing. We want to share all the experience and what we do with you guys. But at the end, if you decide to buy a property, if you decide to sign the dotted line, if you want to take a loan or whatever, it's your responsibility. Please reach out to us, talk to us, call us, email us, whatever you need. Have another pair of eyes look into your deals before you do anything else. If anything else, this presentation is for educational and entertainment purposes. Again, we got back to 21st century deals. If you know anybody that has a deal, if you have a deal, if you have money you want to invest with us, if you want us to look into something, QR codes, boom and boom. Each one will take you to either one of our contacts. You'll have our information, our Instagram, or emails, anything that you need for us to put an eye on whatever you guys want to do. You want to discuss any type of deals, more than welcome. Please, we do. They're there.
Hold that thought. Mine doesn't have my IG. I'm not really good into IG, but it does have all the other contacts. So just sorry, well, yeah, I'll get on IG.
That's okay. He has his flying pigeon. Anything else? Let's see. You have your meet. I think this is the last weekend we do this.
This is absolutely the last week that we do this.
Next week you'll be out.
Next week I will be in California, South Cali. I'm going back to yes. That reminds me of a Biggie song. Gonna be hanging out in Cali next month. Not next week, but the following week after that. So this is the ultimate partnering event. Like I mentioned to you guys have asked us, hey, how do we get involved with your deals? How do we meet other syndicators like you guys that we could put money to work in? And this is one of those places that you could go meet. It's going to be a bunch of syndicators, a bunch of heavy big time operators. David Lindahl is the guy who puts this show to this event together. He is like the godfather of multifamily, has been doing it for 20 plus years. So it's a really fun event to go meet people, learn a ton about multifamily and commercial real estate. QR code is going to send you to the registration page. Use promo code Hernandez and you get an extra discount. I don't know how much longer this is going to go on for. The show is the event is literally like in 2 weeks. So they might can it at the end of this week, at the end of the month. I'm not really sure. Take advantage of it now and be there. And I'll see you there. If you're going, let me know. I will also be hosting or if you're in South California, even if you're not going to the event, I will be hosting a meetup on the 7th. So the 7th. I'll give you guys some updates on that on Slack. I'll be hanging out in San Diego with a few friends, and we're going to make a meetup out of it. So why not?
Be nice.
Yeah. I don't get to go to Cali that often, man. I don't get out of my house very often to begin with. So when I go places, I like to make a big party of it,
I hear you. All righty. So talk to me. What happened to us last year?
All right. So today we have the man, the myth, the legend, Mr. Greg himself. Greg is an insurance expert. He's been doing it for a really long time. He was on previously, but this it was a mixture of a show, and so many things have been going on in insurance. And quite frankly, like Louis said, insurance literally saved our butt after many years of never having a claim, and spending money, or like we think is like, oh, it's a waste of money on insurance. Like I tell you guys, I always insure my projects. I don't care if it's a 30-day flip, it's got a 30-day insurance policy on it, because things happen. We are in Florida, even if you're not in Florida, things happen. Look what just happened in Hawaii. It's incredible. Mother Nature has its own rules, and so you want to protect your investments. And this time it paid us. It paid us tenfold, and all that wasted, quote unquote, wasted policies that we had throughout the years really came through this time around. We literally just reviewed our numbers because there were so many moving parts. We've got deals, we got other stuff going on. And had it not been for the insurance covering the loss, we would have lost money on this deal. Frank, straight up, we would have lost money. It took forever. It was a whole lot of additional expenses. The insurance didn't pay out right away. It took a long time to get paid, but we got paid nonetheless. And they covered our gap. They covered our loss, which is what they're there for. And it was fantastic. So today we got Greg Martin on. He is contact information is on the screen. Guys, reach out to Greg if you have any insurance questions at all. And he's going to share with us the good, the bad, and the ugly, and why we always want to have insurance. But more importantly, he's going to share a couple little tips with us on how to decrease that. Because whether you're an investor or a homeowner, I know you're feeling the pain of insurance. I'm feeling it on my main house. I'm feeling it on my rentals, on my vacation, on the houses I'm trying to buy, on the buildings I'm trying to buy. It is bloodbath out there with insurance. So Greg has a couple little things that he can show us that we can bring down those policies a little bit. It's not gonna go back to 2019 or 2018 prices, at least not anytime soon, right, Greg?
That's right.
Sadly. But at least you could shave off a little bit, and every dollar counts. When you're talking 10% of a $10,000 insurance policy, it's a crispy $1,000, guys. That's not no chump change. So without further ado, Greg, why don't you tell us a little bit about yourself?
Yeah. Hey, Hector and Luis. Good to see you guys again. Thanks for having me back on. I always enjoy talking with you guys. Yeah, a little bit about me. I have been doing insurance since 2006. I started with a nationwide company where we handled policies all across the country. And in 2020, we opened up our own independent agency here in Florida and really got dug into the Florida insurance market. I am a real estate investor myself. I have some rentals there in Lakeland, so I know how important it is to keep costs down, but also make sure we have the right protection. So that's always something I'm focused on, is trying to find good programs out there that can fit those needs. As we've all discussed a bunch of times, right now it's kind of difficult. A lot of the programs are shutting down. Hopefully those are going to start coming back soon in the next few years. But always happy to share any info with you guys and with the other investors on the call here, and happy to cover some of that. Hector, you touched on some important stuff. I think a lot of times with insurance, we forget, what is it? You miss the forest for the trees sometimes. You see how much you pay every year and you go, man, it's cost me so much. Just an example for auto insurance myself, I've been paying, $800, $1,500, however much it is, for so many years. But I did have a claim when I was 18 years old. I hit this guy not very hard, but he was elderly. He had some injuries, and insurance ended up paying out $100,000 on that claim. So if you think how much I've paid, for the rest of my life, I'll be ahead of the game, And so you can use those examples. If you may have done 20 flips or whatever, paid however much in insurance and never used it, but that one claim, if it's a significant one, is going to pay all those premiums and more, and you'll be thankful that you had it. And it works because insurance has all of those policies and only a certain number have claims. They know all that data, and that's why they're able to provide it at the cost that they are. So I know we had quite a process getting that taken care of, but I'm glad to hear it came through and you guys still came out good in that project.
Yep. We were shocked ourselves until the final little penny came in. We were like,
it's gonna
we're on the green side
there.
Right.
But it was moments where we thought, we're like, all right, look, let's just put this property back together. Let's, exit, because that was always our plan. And, we might take a loss in this one. And it would have been a significant loss, like you said, if it wasn't for that insurance payout. So Thank you, Greg.
Yeah,
Thank you for
absolutely.
getting us in the right policy, because at the end of the day, there's something out there, team, to having the right insurance agent that, like Greg just said, one of the things that the first day I spoke to Greg when we first started doing business together, he said, he's like, hey, I have rentals too. I understand what it's like to be an investor. That's a game changer. I've told you guys for many years, if you are able to work, you need a team. In real estate, we always need a team. But if you could have a team member that also does what you do,
Mm-hmm.
and it's providing a service to you, that's a triple win right there. Because now he's not just thinking of like an insurance agent. I have 4 or 5 other insurance agents, but Greg thinks like an insurance investor. Big difference.
Yeah.
No, and the other thing is Greg is not there just to sell you one policy or whatever. Greg is there just to sell you every policy that you need. So it's not good for him. Just try to upsell you for nothing that you're not gonna need. And it's like, hey, what's wrong with this guy? And I think we've all went through that with the different people. Since, I mean, if he tells you, if I got an email from him saying, hey guys, you need to take care of this now, this way, this is the policy I found you. It's like, we've done it. It's like, boom, he goes, go for it.
Yeah.
At this point, we don't even
When
argue or say anything. It's just go.
you touched on something there too, Hector, that talking with a lot of investors, a lot of times the question comes up, should I self-insure? Does it make sense to do that? And, a lot of times people look at how much they're paying out and forget the value they're getting. It doesn't automatically mean that you shouldn't self-insure. If you have a big portfolio of properties, there comes a time where it makes sense to self-insure. Maybe, the things to think about in situations like that is going to be, can you cover a loss if something happens? Obviously you don't want to have that situation happen, but that's what insurance is for. The other thing I find people forget a lot of times is, what's the chances that you have multiple claims at the same time? If you have 5 wood frame houses right next door to each other and there's a fire, you might have all of those damaged at the same point. So it's not just one claim then. Or, if all of your houses are in Fort Myers and it gets hit by Hurricane Ian, you probably don't have one claim. You probably have however many properties you have, versus if you're spread out, Fort Myers, Jacksonville, Austin, Texas, somewhere else, maybe you can absorb a loss a little easier than someone who has everything concentrated. So, just some things to think about when you're thinking, should I self-insure? Does it make sense? Those types of things.
That's actually a great point. Diversification. I've always mostly heard location diversification. I've always mostly heard like, oh, unless you have over X amount of size portfolio, but like you just said, if your entire portfolio is in Fort Myers and you just get wiped out by the hurricane, it doesn't matter how big it is.
Right.
You got 100 houses, you got 100 problems.
Yeah. I mean, and if you have insurance, then it's not as big of a deal. But if you've chosen to self-insure at that point and you're having to cover all those losses yourself, that could be, a significant impact to your business.
Absolutely. Absolutely. So for, let's say, a property flipper like we are, which are the type of insurances that you usually recommend?
Yeah. So normally if you are doing fix and flips, the house is going to be vacant. So you're going to have vacant renovation policy, or if it's like a complete renovation, like down to the studs, you'd get like a builder's risk policy. Those are usually pretty interchangeable. Coverages can vary a little bit, but most of your normal cosmetic fix and flips are going to be like a vacant renovation policy. They are more expensive, and a lot of times they don't cover water damage. You think about it, if you come home every day and something goes wrong, you're going to see it right away. You're going to stop it and you're going to report it, right? These vacant houses, if there's a water leak, it might be leaking for 2 or 3 days before somebody catches it. Or if there's some type of electrical or fire issue, you might not catch it right away. So that's why those policies are more expensive, because if something happens, it's usually more costly.
Got you. Those policy cover full repairs of the house, for replacement value of the house? Do they go by how much is being done? How's the payout on those things?
So it depends on the carrier. Most of those are going to be actual cash value coverage for the existing building. There are a few that will do replacement costs for the renovations. Those ones are usually longer term policies. So if you're doing like, a 6-month fix and flip or a 1-year fix and flip, that's usually a good option. If you're in and out real quick, there's companies that do shorter policies, but they only do actual cash value. It's just usually a better option, because those longer ones often don't do refunds. So like if you pay for a 9-month policy, you're going to pay that amount no matter what. They give you a little better coverage, but you don't get it back if you only use, 2 months.
Perfect. So let's say in that sense, I buy the property 70% off the price, because obviously I'm looking to buy it cheap so I can refi. If we have any type of problem, the insurance will cover pretty much the same amount that I paid. It will not cover all the way up to the current value, but at least it won't mess up my whole business plan. I probably might have to come up out of pocket a little bit, or they might come up higher a little bit, but it will cover pretty much what I paid on the house, correct?
Right. Yeah. If you're getting a discount there, so actual cash value is going to take like the construction of the home as it is now, and then they're going to depreciate it. If you have cabinets from 1960, they're going to say, hey, cabinets have this much life expectancy, you have this much left. So this is your remaining value. Your floors are this old, the house is this old, and they're going to depreciate it. But yeah, if you're getting a significant amount off the purchase price, then that's usually going to cover enough there. And then they'll add the additional cost that you plan to put in it into that insured value.
Perfect.
Yeah, and then that's actually what helped us out right there, right?
Mhm.
Because we had a very similar policy to this one, and we were post remodel, so they used the updated values of stuff, right? If it was pre-remodel, like Greg just said, they're gonna devalue it, but we were already done remodeling, so they were fair and they used realistic numbers. Otherwise, it would have been brutal.
Yeah.
Absolutely. That is and then so you mentioned the vacant or the builder's risk policies, and that's from a fix and flip standpoint, and those all come with liability. But let's dig into standalone liability policies. Actually, you and I are going through this right now. I'm shopping to replace one of my liability policies. Let's talk about when those come in handy. How should those be used?
So liability is usually really inexpensive for the amount of coverage you get. Like when we talk about self-insuring before, I don't think you should ever self-insure liability. You can not get property coverage and still get liability for, usually anywhere from like $250 to $500 per property, depending on how many units you have, things like that. So yeah, that's always worth having. That's if someone's injured on the property and, they try to claim that you're at fault. Even if it's something that the tenant did, you as the owner are most likely going to be tied into that. That is one of the reasons why a lot of your apartment complexes and stuff require renter's insurance, because that'll have an initial $100,000 of liability built in. And so they try to pawn off any small things to the renter's liability policy. So it is good to require that when you can, if your market supports it. But it's always good to have your own liability protection as well, because most likely you're going to be included in that as well.
Kind of like stack one on top of the other. So your tenant policy comes first, renter's insurance comes first, then your homeowners or landlord comes second, and then the liability is kind of like that top last layer. At least that's how I've layered some of my rentals.
Well, yeah. So your liability is going to be similar to that, to the landlord policy there. Like there's the property portion of it, and then there's the liability portion of it.
Gotcha. And is there an instance like I've done in some where you should have both? Kind of, I got my landlord, and then I'll add that policy, that property to my liability policy, just because I have the space.
Yeah, so it depends on the companies there. So like Citizens, if you have rental insurance with Citizens, for example, and you have it in an entity, they won't do any liability coverage on that policy for entities. So then you have to have a separate policy. Sometimes people have like an umbrella policy or an excess liability policy where, yeah, they may have an initial like 300,000 on their rental policy, and then it kicks in after that. That would be like an excess policy. But a lot of times it's not that expensive just to do a straight from $1 commercial liability policy.
Oh, okay. All right. And
just to clarify, to your point, okay, give me a second. Just to clarify to people that are hearing us, let's say something happens with the tenant. The tenant has an accident in a bathtub and breaks a bone. So if you don't have the liability insurance, what happens to you? How far can the tenant or the attorney or anybody can go and hit you in your either business or personal life? What happens if you don't have it?
So I'm not an attorney. I'm not a claims adjuster. So let's put that on there. But the person's probably going to call Morgan & Morgan, and they're going to see, right? I always say people can sue you for anything, and it's up to the court to decide what ends up happening. So one of the good things about liability is it covers the cost of defense. So, where you'd have to go out and hire an attorney to fight Morgan and Morgan, even if it's a frivolous lawsuit, you would have those costs of defense that the liability policy is going to pick up. And that's why it doesn't make sense to self-insure that a lot of times, because legal costs add up fast. What can they go? It depends. Like if you're using an LLC, whether it's a single member or multi-member can make a big difference on it. Whether you have all your documents legit, like your annual meeting and stuff like that. Again, I'm not an attorney, but just from what I've heard, like they can pierce through that legal protection of the LLC if it's not done properly and doesn't have the right documents, if you're commingling funds, all of that type of stuff. If you've done work as the property manager that caused this stuff, that can cause some issues. So, you want to make sure you have the proper protection in place there so you don't have to try to figure that out on your own.
That was a good point that you just made there towards the end when you do some work, because we often have people when they're starting out that want to self-manage. I'm usually, I advocate against it. I'm all for hiring a property manager. But can you speak to that a little bit? Say you are playing property manager / handyman, and you're the one that leaves that board a little bit lifted or something to that effect on the floor, and that causes somebody to trip and fall. Right.
Yeah. So, again, it would be up to the courts, up to the attorneys. I'm not the legal expert on any of that, but yeah, if your entity didn't do anything negligent, maybe your entity's not, but when you did the repair and you replaced that thing, were you the entity or were you the property manager or were you your own individual? Like they can separate all that type of stuff and, come after you as the entity and you as the handyman or whatever. And then, that can make it more complicated. That's where all these things get tough. When you ask a lot of insurance people, oh, is this covered? Sometimes you get weird answers like, it depends. And it's not because they're trying to be tough, but it's like, for example, if you say you have a fire in your house, is it covered? It seems like yes, but now what if it is you lit it on fire? Now it's arson, it's an intentional act and it could be excluded, so you get into all those funny situations and, you think, oh, that would never happen. But after Hurricane Katrina, there was news reports of people that were lighting their house on fire because they didn't have flood insurance. So it wasn't covered. But if it was caught on fire, it was covered. So they were lighting it on fire. And if they didn't get caught, maybe they got insurance to pay it. But insurance would exclude it. So that's why if you just have general questions of, is this covered? It's like, yes, with an asterisk, assuming there's nothing else that applies. That's why you get some vague answers sometimes in those hypotheticals.
It's a maybe. It depends if it's Tuesday or Thursday.
Right. You change one little fact and it changes the whole answer,
Yeah, material facts, right? Those are those things. Right. And team, as we're going along, feel free to pop your questions in the chat. Greg is here to, we obviously have questions and some questions that other people gave us. But if you have any questions, pop them in there. I'm sure, he can answer most of your insurance questions. Okay, so we covered fix and flip policy. We covered some liability, but actually before we get off liability, one last question.
Sure.
How much liability is too much or too little liability?
I would just say you can usually get 1 million in liability pretty inexpensive. Most of the commercial policies we do, that's what we quote them at. 1 million per incident, up to 2 million total aggregate if you have multiple claims. How much is too much? Again, it's one of those hypotheticals for your everyday normal injuries. That's probably enough. If you have, a 3-year-old that gets attacked by a dog that, dies or something like that, is it enough? Who knows? So depending on your assets, depending on, what exposure you have, if you have a pool, that's something that you usually want more liability coverage for. If you have trampolines, that's usually something you want more liability coverage for, although those things are harder to find because they are more risk. So there's less companies that are willing to insure those things. I always hate the trampoline thing. I always want, like, why is it such a big deal? And then I was watching, I think, a Instagram reel or something like that. There's some kid in his backyard, like bouncing, like 8 of them, in a circle, bouncing this kid. Like, I think it was almost 3 stories high and he was doing like 8 flips. I'm like, this is why they hate that. Cause that kid misses the trampoline one time and hits the ground. And that's a huge lawsuit,
Yeah. Yeah, that's always those things. No trampolines in my house.
Right.
I have two kids anyway, so that would be a bad idea.
Right.
All right, so let's dig in a little bit then into landlord policies. Well,
Yeah.
what would we do there?
So landlord policies are going to be a little bit more standard. Your vacant fix and flips are usually more specialty companies. They often go through like Lloyd's of London groups and things like that. There are those types of policies for long-term and short-term rentals as well. But you can usually find your more standard companies like Citizens will do long-term rentals. There's a few other companies out there that will do it. The availability depends a lot based on where it's located and how old the home is. So like right now, a lot of times anything pre 1990, if it's a long-term rental, ends up with Citizens for the most part. Their rates are just hard to beat. There's a number of reasons for that, which are a whole other tangent.
Just to be clear for the people that are not in Florida,
Oh,
Citizens is
sure.
the insurance of the state. Basically, the state of Florida is the one insuring you because no other company is taking it, correct?
Yeah, it's supposed to be of last resort. They should be the most expensive company out there, but right now, a lot of times, especially in coastal counties, they're a lot less than any of the other companies. If there's another company that will give you a quote, um, there are a lot of limitations with the policy to be aware of. If you end up with them, like they don't have coverage for screen enclosures. If you have pool enclosures and stuff, they don't have ordinance or law coverage for rental properties. They are going to start requiring flood insurance on all of their policies. That's going to be a tiered introduction over the next few years until 2027, when everyone is going to have it. And then where we had like 6 companies that went out of business last year because they're backed by the state, they can't go out of business, which is a good thing. But if they run out of their reserves to pay claims, then they can do an assessment up to as much as 45% of your policy premiums. So even though the rate may be less, if they have a big assessment, it could be an added cost. That's something to just factor in when you're making your decision between what policies. If you have one that may be a little bit more expensive, it might be worth considering versus a Citizens one, unless Citizens is drastically less.
Perfect. And that assessment will be on your taxes, right? They will add a new big assessment of taxes and
It'll be on your insurance.
on the
It's
policy.
an insurance assessment. Yep.
Okay.
They haven't had to do it in a long time, but as more and more people are moving to Citizens, if we
Mhm.
have another big storm, the chance of them depleting their reserves goes up because they have
Gotcha.
more
Yeah.
claims to pay.
Okay. You mentioned something that it's pretty much brings us to the next question I have for you. Any property older than what 1990, nobody wants to cover it.
Yeah, I mean, you can find it sometimes, but it's more difficult for sure.
Okay. Is there anything we can do to our old properties so new companies, other companies can take it, or they just go by the build date? I mean, can we do any kind of improvements or anything that's worth doing
So
to
some of them,
lower it?
yeah, that's a good question. So some of them will go by like the age of the roof and the age of the water heater, but as they came with more legislation to try to keep insurance available for people, they've changed away from the age of those things a lot of times to the age of the property in general. So there's nothing we can do to change the age of the property. If the company goes by that for an underwriting guideline, it is what it is. Having some of those updates may help with some of the companies and give you more availability. And then there are some things with those older homes, depending on what company you're going with. And that's where it gets a little bit more fine-tuned, just ways to save some money though. So if you're with, I know a lot of people like to use NREIG. I know they aren't really writing a whole lot down here right now. But some of those more Citizens companies don't have wind mitigation credits. So it may not help you if you're going that route. So I would ask your agent before you go out and invest money for some of these updates. But if you have Citizens, or if you have, like Southern Oak or Tower Hill or any of those like admitted companies, they have wind mitigation credits. On the older homes, what you may find is the way the rafters are attached to the walls can make a big difference. They used to just use nails, and there's no credit for that. But then they started using clips and they started using straps.
Mm-hmm.
So those do give you a pretty big discount. I've seen them make anywhere from, a small amount if it's a newer construction home, up to as much as like $1,500 savings per year if you have some of those construction features. That's a big difference. And one of the things is it requires 3 nails in the clip and 3 nails in the strap. Sometimes in the past, they were installing those with only 2 nails, and so it doesn't give a credit for that. So one of the retrofits you can do is called the 3rd nail. And there's a ton of companies out there that do it. The cost varies based on your attic access and, you know, how easy it is for them to get to it, but they can put that 3rd nail in, and then you qualify for that credit.
Perfect. That sounds fairly easy if you have the access.
Yeah.
Actually, it does sound fairly easy. And sorry, guys, I had to kill the video. I have a sick baby. This is the real life real estate show, so I had to take over, and I have the baby on me. But I did want to kind of throw out a point, because on the current home where I live, and I just threw a link in there, Lou. You could that's kind of what the structure looked like. I consulted with a company to do that work, and
there it is, the clip.
really wasn't the most inexpensive thing, because this particular home doesn't have a very wide attic, so they would have had to go through the outside. So it was a whole lot of breaking concrete and then refixing concrete and stucco, and it was not the least a super inexpensive project to do.
Yeah, sometimes it's not. I've heard them. Sometimes they're able to go through the soffit and get into it. Other times people do it when they're replacing the roof, and they'll cut like 3 feet back off of the plywood decking. Of course, then you have the added cost of replacing the plywood, but that's another way they can get access that may keep the cost down. And then, how long are you going to hold it? So if you're saving, $1,000 or $1,500 a year and you're going to keep it for 10 years, probably worth it. If you're going to hold it for a year and then resell it and move on to the next project, maybe not. So that's certainly something to take into consideration when you're deciding that.
Yep, it's that cost approach.
Yep,
I like it. What else can we do to save some money on insurance, Greg? So we covered hurricane protection or wind protection, and you could dig into that a little bit, what that really means, and then what else that you think that is doable out there.
Yeah, so the wind protection is probably the biggest one. Again, if you're with a company that has those credits, so always ask if you're on like a specialized investor program, it may not offer those credits. That's usually the main thing for your rentals. You usually won't have personal property coverage if you're doing it unfurnished. So if you have that, you can probably remove it. But most of the time you already have that taken off. Deductibles is probably the next biggest thing. And kind of similar to the self-insurance question, is just what's your break-even point? I hear a lot of people that say, hey, I want a high deductible. I want to go from 1,000 to 2,500 because I'm never going to put in a claim that's, $1,200. I'm only going to put in a big expensive claim. And that's true. But the other thing to think about is if you have that $100,000 claim, you're going to put it in, I'm sure, right? Like that's why we have insurance. You're going to pay an extra $1,500 out of pocket towards that claim. How much did you save per year to get that higher deductible? If you save $20, it's going to take a long time to save that $1,500 that now you paid in that claim. If you're saving $500 a year, then it's probably worth it. I usually tell people if it's less than 5-year break even, to me, it's usually worth it. If it's like a 20-year break even, it's definitely not worth it in my mind. And then if it's like a 12-year, 15-year, whatever, it's really what you're comfortable with. There's not a right or wrong answer with deductibles, as long as you understand, what the trade-off is. Yes, you're saving some money. You're going to pay more if you have a claim. And are you comfortable with what that means? That's the biggest thing there.
It's, can you take the hit, really, right? Because it's just kind of like that question that we talked about. You go from $1,000 deductible to a $2,500 deductible, but you have 10 or 20 properties, that's
the same location.
25, 50 grand. Can you fork that out real quick?
Right. It does. It all adds up. So that's something to take into consideration. Just, I had a guy one time, he wanted to go from 1,000 to 2,500. He was saving $4 a year. And he's like, yeah, let's do it. I'm like, dude, it's going to take you like 250 years to save that back. And he's like, yeah, I don't care. Let's just do it. I'm like, okay, you can make that choice for sure. And as long as he understands it, it's fine. To me, to save $4 is not worth it. If you ever have a claim, you're going to have been better off with that lower deductible at that point. But, it varies a lot based on the company, the property, things like that. So it might be a big enough savings to make it worthwhile. It may not be.
Okay, and then so let's dig into, for investors, because there's investors watching this, and we're investors. So if we're gonna buy a rental, and as you know, traditionally the older rentals, right? We've done a lot of fix and rent. I've done a lot of that, right? I buy the older ones, I make it a little bit nicer, throw a new roof on it, whatnot. But clearly right now my insurance is much higher on that 1960, 1970 home. I have like 2 carriers willing to insure me, if that.
Right.
Versus something either brand new or a couple years older that's got the latest building code, but it's going to cash flow less on the surface, right? When you first look at it, because it's so much more expensive. Where do you see that benefit to going newer, or do you think the older ones are still viable options with the way things are going?
That's loaded.
That's a good question.
Yeah.
Where things are going is hard to tell. So I'll tell my non-insurance story. I'll talk about one of the guys that comes to one of the real estate meetings that I go to here in Tampa. He's been doing it since the 70s. He has tons of properties. Had a lot of the older stuff, like you said, that was fixed up, nice, good shape now, whatever, but it's still old. And he said when 2009, 2010, when that was coming around, he said, upgrade your portfolio now. Like trade 2 of your old ones for 1 of the new ones. You're going to save insurance. You're going to save repairs and maintenance. It costs more. So, but prices were so decreased at that time. That's not where we are right now. But if things, get tougher, we might see stuff come that way. So just something to think about. Also, the phrase he always said that I think is true is when you buy your property, you buy your tenants. If you're buying in not the greatest part of town, you're going to have not the greatest kind of tenants a lot of times. And if you're getting a nicer, newer home in a nicer neighborhood, whatever, you're going to attract nicer tenants. So when you buy your property, you buy your tenants.
Which also helps you bottom line, right?
Right. Yeah. If you can avoid vacancies, you can avoid damages, you can avoid, all of that type of stuff. It definitely in the long run pays off.
Yeah, I've kind of noticed the last few that I've been running. As you know, we've gotten pretty in depth with the BTR stuff, and the build to rent, the brand new product is it's almost starting to be the same kind of return almost, because it's so much more expensive to do the rehab now and to maintain the older homes.
Yeah,
that in some areas it is almost making sense, man. That class A stuff is really making its way up to the top. Like you said, we're still not in a super depressed environment, so some of it's still not, unless it's like the larger multifamily, they're still not making perfect sense yet, but they're starting to get there. You're seeing builders make really great concessions. Yep. Just had a call with a mentee here from Real Life Trading, and he is having builders offer incentives at the closing table in order to help buy down the rate. So wow. That's those are great incentives that builders are putting out right now, because they got to get rid of those houses.
Right. Yeah, absolutely.
Or duplexes or whatever they are.
Yeah, and insurance on those
were the duplexes, yes.
New construction, the insurance on those are drastically less. Like it's not even a little bit less. Like 2003 versus 1990, like maybe a little bit different, but like new construction is usually drastically less.
Well, when you say drastically less, let's put a percentage on it. And I know that's a really hard global answer, but just throw a number out there. What you think, a range or something? Is it like 20% less, 60% less?
No, I mean, I would say more. Well, so let me say for rentals, I don't do a lot of new construction rental insurance quotes, obviously. So I'm going to go to owner occupied just as an example, but owner occupied will a lot of times be half price, maybe like a new construction owner occupied. It's not unusual to get 1,200 to 1,500, and like a 1980 similar house. It's not unusual to be, $3,000.
Wow. So that is a big difference. So, when you kind of divide that up, you could almost pay a little bit more in mortgage and get that nicer house instead of paying it to the insurance company.
Yeah. Now there's not as many, landlord companies, like as these companies, I think they just announced 2 or 3 new insurance companies coming to Florida, and things like that hopefully will help the market in the long run. But all these companies always want owner occupied first. So you're going to see an improvement in owner occupied first. Then long-term rentals will be the next one that they go to. And then short-term rentals are like the one that they want least. Just because, again, the turnover, the people that care about it, your owner occupied, they refer to it as like a pride of ownership. You know, you aren't going to let things break down, leak, things like that. If you see it, you're going to fix it. Where your long-term tenant might not, and your short-term tenant, he's just here for his vacation and then he's gone. So, you know, that's why they kind of view it those ways for the long-term risk on it.
That makes sense. Well, that was, we're definitely rounding the end here. We got a few minutes left, Greg. If you could share with us, thank you for all those tips, by the way. I'm sure I'm going to start making some changes. Well, we're already making some changes based on what you've told me, but we're going to start saving some more money on insurance. What do you see coming down the pipeline and the industry? I know last time we talked, there was some legislation. Any progress there? Are we going back to 2019 insurance prices anytime soon?
So not anytime soon. I've started hearing more agents from across the country talking about difficulty getting insurance in their states as well. They're saying right now it's generally what's called a hard market, where a lot of these insurers don't want new coverage. It's spreading into auto insurance as well. Auto insurance is getting tough. But yes, the legislation from last December, they're still optimistic about. It usually takes about 18 months to filter through. They have to see, one, will it hold up to court challenges? Number two, does it have the intended outcomes, or did it cause other side effects that they didn't expect? And then once all that happens, then they have to recalculate the rates, file them with the state, and then it has to get into your policy when your policy renews. So the whole thing takes like 18 months. So we still have a little bit of time before we should see the real true improvement from that, but they are still optimistic. So hopefully if we can weather the storm here for a little bit longer, we'll have at least some positive news in the foreseeable future.
Good. At least one of the good things is we're almost done with summer and we haven't had any major, I mean, fingers crossed, but
don't jinx us. We got one out there right now, and August and September are usually the worst months of the year.
Big.
So
I know.
Don't jinx us.
They usually come for Labor Day. I know. But all right. So do we have any questions? Anybody from the chat? If not, let's wrap it up. You have Greg's information right there on the screen.
Greg, how can we reach you? How can we reach you, and how can we add value to your business?
Yeah, absolutely. If you have any questions, usually email's the easiest way to get a hold of me because I can respond as quick as possible there. Feel free to give me a call though. Send me a text. I'm always happy to chat, answer any questions that you have, and help you with any of your investment properties here in Florida.
Thank you so much for coming on, man. It's
Appreciate
always
it.
good to talk to you.
Yeah,
you know,
too,
we were
guys.
having this long conversation the other day on the phone. I'm like, you know what? Let's just get you back on the show because I'm being selfish here, just recording all the information because it's necessary. We always need to update. So thank you so much for coming back on, man. It's great to have you on. It's great to see you as always. And yeah, thanks for sharing the knowledge, man.
You too. Nice talking with you guys.
Thank you.
As always, hope you have a great weekend.
You too, my friend.
Take care, bud.
Thanks.
All right.
Lou. What else you got on here? I'd say we are done. We got one more announcement. We got one more announcement before we go. Mentorships.
There you go.
Back by popular demand.
Go ahead. Go for it.
Oh, I had this whole thing, dude. Back by popular demand. Hector's doing another mentorship group. That's right, team. I will be doing my group mentorship starting on the 14th. I got the afternoon shift. Lewis is starting a little earlier, so you want to get on there and get signed up soon. He's starting on September 6th, and he is taking the PM shift. And these mentorship groups are meant to get you started, get you going in the real estate business, whether you want to fix and flip or fix and rent. There's one thing that both of those strategies have in common, and is you have to buy right. Lewis has bought a lot of properties right. A couple of them wrong. So have I. So we've learned a lot. We want to share that information with you. If you guys are looking to get started, check it out. Check out the website. I believe it's about to go live.
It's about to go live. It's here. Usually in real estate, you go to real estate tab, and it should go live when it says coming soon. It should go live, if I'm not mistaken, this weekend. Okay. So any
Awesome.
questions, you can find us on the top in real estate, or you can find us in the bottom on real life real estate. Okay, we're always there in both ways. So besides that, do we have any questions? If not, let's wrap it. Again,
Thanks everyone for watching another edition of the Real Life Real Estate Mentorship Group. If you're watching us on YouTube, don't forget to hit like and subscribe if you're not a subscriber, but you should be a subscriber by now. Yeah. QR codes are on the bottom of your screen. Once again, reach out and let's get connected if you have not gotten connected with us. You can wrap her up, buddy.
Thank you, guys. We are real estate at reallifetrain.com. I already showed you where we live. reallifetrain.com/RE takes you to that page that we just showed you. Thank you for being here. Thank you for listening to us, and see you guys in 2 weeks.